Good afternoon, everyone. We really appreciate everybody joining at this time. We have an excellent panel here to discuss a very important matter that is very, very relevant to the UAE in general and to the designated non-financial businesses in particular. I will quickly introduce our panel and myself at the end. We have with us, joining us from Washington, D.C., Brian Steigerwalt. Brian is the Senior MD at K2 Integrity, and he was previously the Chief Executive Officer of the Dubai Financial Services Authority in the DIFC. We have joining us from New York, Stuart Jones, who's a co-founder of Sigma Ratings, and was also previously the Treasury, U.S. Treasury Attaché to the Middle East. Welcome, Stuart. And we have Andy Walker joining us from the Dubai Financial Services Authority. He's a senior manager in the supervision team, and he spent about 75% of his time in the private practice and was also an MLRO. And my name is Jahan Zabawan. I'm the founder and CEO of J1 and Partners, a GRC consulting firm, and also the founder and CEO of Azaka, a regulatory technology company that are sponsoring this webinar. So I want to thank everybody who has joined us. I want to thank the panelists as well for their time. We would like to make this a very interactive and straight talk as we want to make sure that you get the best out of the discussion. If you have any questions for some housekeeping matters, please type those into the question section, and our moderator, Jack Collins here, would make sure that the relevant questions are asked to the panelists. We will have a discussion for about 30 to 40 minutes between the panelists. We have some questions that we want to ask them and get their thoughts. And once that is done, we will come to the questions of the participants. So without further ado, I would start with the very fundamental question, and this goes to all of the panelists, is why are DNFBPs required to comply with the AML regulations? This is a fundamental question. I think some of the businesses don't understand that. Sometimes, generally, there's a lack of understanding in this concept. So I would start with Brian. Brian, why would you reckon that that designated non-financial businesses need to start? And in your view, who are the designated non-financial businesses?
Well, good morning, everyone, or good afternoon, I guess, in Dubai terms. And thanks for organizing this, Jahan Zeb. I think this is a really, really interesting topic. And one that is becoming more and more critical, I think, around the world. So you've got the timing right with this. In terms of why DNFBPs are important is because they're often the gatekeeper on the way to the financial sector. And the D is important. These are designated non-financial businesses and professions, and these are the ones that the Financial Action Task Force, the types of businesses that the Financial Action Task Force has decided pose a risk to the global system for money launderers and terrorist financiers because of their gatekeeping role, because of their company formation role, because of their accounting, auditing roles, because of their handling of high value transactions where money launderers would typically want to launder. The role of DNFBPs in the global system to fight financial crime is absolutely critical to making the whole system work.
What wonderful, Brian. Stuart, what are your thoughts on this?
I think Brian's spot on, and I would just add that a lot of the time, DNFPBs we've been talking about for some time. It's not a new concept, but I think that the timing, to Brian's point, is really important. And a lot of times in this space, it is the timing. And I really think that the Panama Papers and some of the events that we've seen transpire in the newspaper and in movies and in a variety of other places have given way to conversations about this particular sector that maybe wasn't there before. And, people are sort of scratching their head and asking themselves questions around, how are these things being formed? How is it possible, that a couple of law firms could set up literally thousands of companies to create layers and layers and layers? And what are we doing about it? And that's creating a lot of energy around additional regulation, additional scrutiny, and we're now seeing things move from DNFBPs are important to in the EU 6 directive, for example, aiding and abetting a money laundering or fraudulent activity is the same from a penalty perspective as doing the crime yourself. So this is really starting to take hold. And here in the United States, where Brian and I are, there is enormous pressure on art and antiquities. There is enormous pressure on real estate with a number of FinCEN advisories that are coming out around oligarchs and others looking to move vast sums of money to the United States. And there's increasing scrutiny as well on law firms and what law firms' role as enablers in all of this is, and how that should be looked at from a MLRO perspective going forward. So agree completely with Brian. I do think a lot of it's about timing, and it's very much top of mind, not only here, but in Europe, and certainly in the UAE as well.
Thank you, Stuart. And Andy, coming to you, how would you define a DNFBP, particularly in the context of the DFSA? And what would be and the second follow-on question would be, what would be the expectations from a policy and procedure and appointment of a money laundering reporting officer standpoint?
Thanks, Jahanzeb. I'm just touching first on something Brian mentioned, which was about FATF. And of course, the UAE needs to play its part in the international fight against money laundering and other financial crimes, and to apply international standards. And as I imagine everyone will be aware, the UAE was subject to a mutual evaluation by FATF in the last couple of years. And one of the areas that FATF focused on quite heavily was DNFBPs and their role in the financial system as gatekeepers. So I think that's a very important point that Brian mentioned about gatekeepers. The old saying, a chain is only as strong as its weakest link. It doesn't make a lot of sense to have extremely stringent controls in the traditional financial sector, but differential standards of controls applicable in the DNFBP sector, because you are leaving a gaping hole for criminals to exploit. So in terms of how the DFSA sees things, we expect the same standards from a DNFBP as we would from, say, a bank, for instance. There is no difference within the rules, apart from Chapter 9 not applying to DNFBPs. Everything else is exactly the same. A DNFBP in the DIFC is the same as it would be in the mainland, for instance, in terms of the types of activities that qualify you as a DNFBP, but just the nature of the DIFC itself means that we don't really have a very strong presence from DPMS, for instance, and we don't have any brokers or real estate agents or brokers in real estate. So that's the only difference. Everything else is broadly the same.
Wonderful. Thank you, Andy. Really appreciate that. So I think the key question, I'm sure, for the audience here as well is: look, I understand there is regulation here from a money laundering and countering terrorist financing standpoint. What do I need to do to comply with these regulations, and what do I really need to? What risk am I taking by not complying, and what do I need to do to comply with it? Both in terms of documentation, because in our experience, financial services are very used to, and this has been drummed into the financial services business as to the AML KYC part, the nature of some of the designated non-financial businesses, like your real estate brokers, your real estate developers, high-end jewelry shops, precious metal dealers, et cetera, et cetera. It's a bit more difficult especially when you're asking questions to your clients to provide information. I'm sure people sort of face some resistance from the clients. So the question for you is, how do you sort of comply with that? And what's the expectation, and what's the penalty in terms of non-compliance, both from a local regulatory perspective and the larger international perspective?
Sure. The rules in the DRC state that you may take a risk-based approach to compliance. And that allows a firm to focus on the areas of higher risk and take a more streamlined approach in areas of lower risk. However, the starting point is you must understand your risks before you can manage them. So the starting point would be to conduct a business risk assessment, business AML risk assessment, and that is your blueprint for your framework for compliance moving forward. And from that springs everything else. So all of your systems and controls, your policies and procedures are a product of that risk assessment that you've conducted. It's important that the risk assessment is tailored, and it covers the activities that your firm undertakes, and it properly measures and classifies the risks. Once from there you build your framework, the expectation would be, from a regulatory standpoint, is that you apply that framework in a consistent way, in an effective way, and that you test your framework and update it periodically in response to changes in legislation, for instance. But testing should be something that you should undertake periodically anyway. You can't just presume that everything is working okay. You need to actually verify that.
Okay, so I have a question here, right? So the key thing for a lot of the DNFBPs, they don't have the expertise to conduct a business risk assessment, because that's almost always a challenge, especially if you are. I would give that to the accounting firm or the law firms. Maybe there's some expertise there. Mostly accounting firms, maybe not so much as law firms. But everybody else, I think, struggles with a set of expertise, and this is both DIFC and outside the DIFC. So the question for you, Brian, here is, how would they go about doing this from a practical standpoint, right? What do they need to do? How do they go about doing that? And then I'll come back to the question about, what happens if you don't do it, right? What are the potential challenges you will see? So first, in terms of how you go about doing it, do you do it in-house? Do you go to somebody else? How do you sort of keep it up to date, as Andy was mentioning? What do you think?
Well, there's not a real short answer to that question, but and it does come off of a little bit of what Andy has said, that it's a kind of a risk-based approach that you have to take. And it's also an approach you have to consider as you grow as an organization, whether you want things in-house, whether your organization is big enough to have this in-house investigative ability, or whether you want to go outside and use a company to do investigations, for instance, K2 Integrity, or for instance, J1 and Partners, and the sophistication that Sigma ratings can bring to the table here as well. So there are a lot of products, there are a lot of services that you can go outside your organization if you don't feel that you can match up with the standard that's expected of you. But there are clearly, I mean, everything you read right now, and we're talking this year, you can clearly see there's going to be growing pressure on the DNFBP sector, because people are connecting dots, that you have sanctioned individuals, and you have things that those sanctioned individuals own. And in between that person and that thing, you have about 10 companies. And someone set those companies up. Someone's doing accounting for those companies. Someone put together the corporate documents for those companies. Someone's acting as the board of directors for those companies. And so clearly the US and Europe, you can see, are saying, listen, we're tired of trying to make all these connections ourselves, and we're going to go after the people in the middle. So I think you have to really watch this space in terms of regulatory action and enforcement actions against people who are in the middle. And when you start talking, I mean, Andy did a great job, I think, of explaining the rules and expectations here. But let's take a step back and say this is not about rules. I mean, this is about preventing someone who's committed a crime from laundering their money. And so at the end of the day, that's what we're doing, is making sure that committing a crime becomes more difficult. And anything we can do in the way of that process should be done.
Wonderful. And I think I'll pick that up from what Brian is saying. In terms of the challenge always is implementation of the expectations through documentation, through training. So Stuart, in your opinion, for a DNFBP, let's say, and I'll go to the key sectors in the UAE, particularly, let's say the real estate brokers, the real estate developers, the precious metals guys. How do they, first of all, what do they need to do from a practical standpoint of putting together systems and controls that allow them to evidence that they are trying to comply? And then two, what they would have to do from a training point of view, I guess, because obviously there are different points of entry within each of those businesses. How would they go about doing that? So the people who are attending, they understand in terms of, practically what can be done.
Yeah, I mean, to piggyback on Brian, I think it's very, dependent on who it is and the size and maturity of the organization that is in question. But I think broadly speaking, and to Andy's point as well, getting in place, in understanding your risk is paramount. If you don't understand your risk, you can't manage it. And I do think there are some great firms, many on this call, that can help a firm sort of assess and understand what that risk surface looks like for them. I do think also, to Brian's point, the risk surface facing all of these firms is expanding, not only from let's make it difficult to stop people from laundering their money, but there's also, increasingly an ESG element to this, a reputational risk element to this. There are so many other things to think about, even beyond just what is regulatorily expected, in my view, in terms of what people should think about when they think about that risk-based approach, which is a bigger, longer conversation. But I do think, from a systems perspective, things have gotten easier to manage that. Everything used to be a very manual process, but with the advent of new technology, better onboarding systems, escalation workflows, et cetera, a lot of this can be further automated and make the life of the DNFBP that's trying to comply with these regulations and trying to make people's life harder, that's trying to launder money. It can make their job a whole lot easier than maybe it would have been 5-10 years ago. So, two-part question, one, got to know your risk. Two, the ability to manage your risk is getting easier and easier with technology. And there's a ton of folks out there that can help these guys get up to speed, including someone like Azikal.
Wonderful. So I think continuing with the same theme, the important thing for us to consider as well, and I think this is where the gist of the discussion is going, is the practical application of not only the tools but the understanding, right? So coming back to you, Andy, what would you expect a DNFBP from a training point of view, right? To have in place. Do you go in and say, okay, well, show me your policies and procedures, show me how you've trained people, and do you look at some instances of issues that they have been able to highlight? Is that a way to identify whether training has been appropriate? How would you sort of, in a regulatory frame of perspective, put all of this in?
I mean, training is an absolutely key piece of the jigsaw. You can have excellent policies and procedures, systems and controls. You can have wonderful technology. You can have great consultants at your side advising you along the way. But if you've then got staff who are lacking in awareness and understanding, you are leaving a hole in your defenses, because your technologies obviously are designed to do all sorts of things, and they do those very well. But you must never miss out the human element and the fact that your staff are your first line of defense against potential abuse by criminals. So if we were assessing a firm, certainly we would look at the approach that they take to their training. It is important that firms understand that there is no such thing as one size fits all training that can deliver compliance. There is a tendency for some firms to go out to a firm of consultants when they don't necessarily have the expertise or time themselves internally to do that. And those consultants will provide them either with face-to-face training or an e-learning package. And those materials are generally of a very high standard, but generally speaking, they are not tailored to the particular firm and their particular business and their particular client base and their particular risks. Sometimes they are generic and they're not tailored to the UAE and to the DIFC, so it doesn't capture local requirements. Sometimes you find there are gaps in the content. So for instance, a common theme is proliferation financing does not get any coverage. Terrorist financing and targeted financial sanctions generally are not covered in as much scope and detail as we would like. Sometimes red flags are missed out. So there are a number of areas where commonly there can be a shortfall. One thing to bear in mind is that you must train all of your staff. And obviously that goes all the way from your board of directors and your CEO, your executive management, all the way down the hierarchy within the firm. Any staff who are in particularly high risk positions, so where they're dealing with client funds or they're dealing with clients themselves, they should receive additional training because that is addressing your risk. That is a risk-based approach. For someone who isn't in one of those roles, they can perhaps have a slimmed down version of the training. It's worth bearing in mind that your board members and your senior executives, they have specific responsibilities under the federal law and also the DIFC rules. And therefore they need specialist training as well, so that they can understand their responsibilities and fulfill them. The final piece in the jigsaw is for your specialist staff, your MLRO, and your AML unit or your compliance team or whatever you may call them. They should receive specialist enhanced training as well. It's good practice for them to also have professional qualifications ideally, although that will vary from firm to firm.
Okay, perfect. And I definitely want to press on this a little bit in terms of expectations. And we talked about the DFSA. Now, from your experience, Brian, more widely in the UAE and the Middle East and globally, what would you reckon is the expectation? I know it's generally basically similar to what the DFSA is saying, but consider the practical reality. For example, onshore UAE is a different sort of commercial setup than within the DIFC. So the typical expectations of the UAE regulator, particularly when it comes to finding out suspicious transactions, filing suspicious transactions, and what happens if you don't do that. If you can talk a little bit about that, that would be really helpful.
Very good. I'm shocked to hear that consultants would use the same presentation twice. Fair point, Andy, and a message received on that front. And it does go directly, I think, to the heart of a culture of an entity. If they want training to be a tick box exercise, hey, the regulator wants us to be trained, hire somebody, pay them $500 and move on. You're going to get that same presentation because the company's not serious about learning anything. But if a company's serious about learning anything, then probably like we're going to be doing today, that the presentation should be about half the time and the Q&A should be the other half when you get into a risk-based discussion of the specific business model that you're dealing with, the specific vulnerabilities of that business model, and how do you mitigate the money laundering, terrorist financing, and proliferation financing risks. So 100% right on that front. And as Andy mentioned earlier, in the FATF mutual evaluation, I mean, the UAE was pretty heavily criticized for the DNFBP sector. But we also have to, I think, give some credit to the Ministry of Economy for stepping up to the plate on this and bringing more standardization to the DNFBP sector across the UAE, and taking some enforcement actions that we've seen as well in that sector to remind people that there's penalties, including closure of business. We've seen that as well. Where licenses have been removed, not only fines have been issued, but licenses have been removed. So there's clear risk on that. The UAE is taking this seriously. And in the most recent plenary of FATF, I mean, I think there's the statement that came out talked a lot about ensuring a more granular understanding of money laundering and terrorist finance risks, particularly in the DNFBP sector. And these FATF communications may sound generic. They're not written as a generic statement. You should read the points and understand that this is an area. There's only 4 bullets, in their highlights here, and this is one of them: granular understanding in the DNFBP sector of terrorist financing, money laundering, proliferation finance risks. So people should be taking this seriously and forcing those consultants to do something other than a generic presentation.
Thank you, Brian. So Stuart, I'll come to you on this actually, particularly around terrorist financing point. This is, again, I think it's very, very important for the participants to really understand that, although our intentions may be pure, but the outcome may be quite the opposite if you're not careful. And what we have seen is the lack of systems and controls evidence lack of care, which evidences potential misconduct. And I definitely want you to comment about, the criminality of or the criminal nature of money laundering and the implications of that for somebody who is potentially involved in that, not only from a reputation standpoint, but also from a personal liability or corporate liability standpoint. So if you can comment on that, that'll be wonderful.
Yeah, I mean, look, it goes without saying, but it's super serious. The consequences of being on the wrong side of terror financing or money laundering, or frankly, sanctions evasion as well, which means, knowing your risk, knowing your customers, having these things in place is critically important, not only, just to be on the right side of regulation, but without following this, there's consequences to humanity. There's also consequences to the viability of your business as well. I think one wrong step in this could spell disaster for a firm, particularly in this current environment, and would implore people to, as Brian says, really read and look into what's being said in terms of the messaging around expectations from FATF as well as expectations on the national level. And one point I wanted to make too, on the training, is in that sort of feeds into this point, is that something that I've seen both in government and in consulting prior to Sigma Ratings was the benefit of being very specific from a typology perspective on the type of things that can happen for that particular business. So a real estate typology is going to be different probably than for a precious stone dealer, which is going to be different probably for a law firm. And so the way that I learned growing up was a lot of times I needed to see an example of how things could work. It doesn't mean that's how it's going to always work. But I think, you know, for the people on this call, asking your consultant or developing internally by looking at FATF typologies and other typologies that are out there, how are criminals using real estate? How are criminals using other parts of the DNFBP landscape to get around the laws and get this money into the formal financial sector? If you can see examples of that and learn from that, then I think that also helps you better sort of put in place a risk-based approach for your organization, because you kind of know what to look for and you kind of have some ideas of where this is going to come from. I don't think people sit around and just know necessarily off the top of their head how someone's going to try to attack their industry to launder money, but there are plenty of examples out there and people that can help you understand how that's going to be done and help you raise your defenses as a result. So I would emphasize that speciality component of it as well, which I'm sure the very fine consultants out there are working into their presentations as we speak.
Thank you, Stuart. I think I definitely want to talk about some examples here, because for the audience, I think it'd be very, very, very useful. The basic thing that we have been taught, as Stuart said, is, you know, if it doesn't smell right, it's not right. And sometimes, you know, you always tend to disregard your feeling that about a certain transaction. And in that same vein, you know, particularly cash dealings. So Brian, I'll come to you on this. You know, in this day and age, how would you sort of view lots and lots of cash coming in and being used for certain things? Or can you give us a couple more examples of different typologies in different sectors, real estate being one, or some others, or law firms or accounting firms? That would be really helpful for the people on the call.
Yeah, so you know, the difficulty probably in the GCC is that cash transactions are relatively normal, you know, and so that poses a bit of a problem, I guess, because money launderers also know that cash transactions are more normal in the UAE, and then it goes from, you know, your risk-based approach of, okay, buying a car, you know, maybe you could live with something in cash, but once you drift into real estate and you have a high value of an asset that you're looking to purchase, I think the cash transaction then becomes a risk that I would not want to take, because the volume of money you're talking about in buying a villa or buying multiple villas with cash, to me, leads me to the question of you're trying to hide something, you know, and so the amount of digging I think you have to do around that cash transaction for something that's that large, I think is significant. And if you ignore that risk, you ignore that risk at your own peril to getting this right. So I think you could probably put together, I mean, hundreds of, you know, different typologies along those lines. And real estate's a difficult sector. And, you know, the DNFBP sector, if you look at the FATF ratings worldwide, you know, compliance with the DNFBP recommendations, whether 22, 23, I think, are not that high, you know, so this is a worldwide problem. It's not a UAE specific problem, although the UAE was heavily criticized in this area in the mutual evaluation. So cash, a lot of cash is a lot of problem down the road potentially.
And I'll come to Stuart on this. I think in this day and age also, cryptocurrencies are, well, at least they were a flavor about a year and a half ago, and they still continue to be the flavor. How would you view, or DNFBPs potentially either getting paid in cryptocurrencies for services that are being provided, or selling services or products, in exchange for various cryptocurrencies? What would you reckon would be the view there, considering the complex, I guess, technological issues around that?
Yeah, I mean, I think if you have the right systems and controls in place, it's a form of value at the end of the day. And as Brian points out, with the right tools, it's easier to track the provenance of crypto than it is cash. That's not something I've dealt with that much. I know you can buy a Tesla with Bitcoin. I'm not sure. I've not been offered the opportunity to buy real estate with Bitcoin yet, or watches with Bitcoin yet. But I do think that that will probably continue. It's not going away. And I think that tokenization in general is coming, and so firms are going to want to accept payment, how they can accept payment to do commerce, and that might be in fiat, that might be in digital assets, and so, but I think if you're getting into digital assets, being able to understand that risk from a control perspective, it might require some additional advisory from a specialist firm. It might require some additional tools to do technically, but there's no reason why you couldn't do it, as far as I see.
Okay, no, wonderful on that. Andy, a question for you around suspicious transactions. That, I think, is a very important part of the discussion. When would you say a DNFBP needs to file a suspicious transaction, and what would be the expectation for you when you're receiving a suspicious transaction report? What do you want to see in that?
The simplistic answer to that would be in terms of the trigger for the submission of an STR, that would be either knowledge or suspicion of money laundering or terrorist financing or proliferation financing even. Now, the important part there is the terminology knowledge or suspicion. It would be pretty rare for a firm to have knowledge of laundering, to have knowledge that the funds are from a tainted source. Although I am aware from previously my career of one case where amazingly the individual actually admitted that the funds were from a crime. It sounds bizarre, but it did actually happen. So yeah, I still can't believe it myself. So it's important to note that you don't need proof. The firm doesn't need proof. It needs to have reasonable grounds for suspicion, or in rare cases, knowledge. So what would the regulator expect to see in that regard? Well, we would expect to see the firm to have in place the appropriate framework to enable them to reach that point. So as we said before, appropriate policies and procedures, systems and controls operated consistently and effectively, tested occasionally, appropriate training, appropriate monitoring and surveillance of clients, not just transactions, but in the wider sense, activities as well. And if you have your framework in good shape, if your staff are appropriately trained, if your monitoring systems are calibrated and working effectively, you stand a much better chance of detecting a transaction which potentially is hooky. Now, of course, the next step comes, well, okay, you might have identified something as potentially laundering or potentially suspicious. At that stage, it's potential, it needs further investigation. We would expect a firm to carry out that investigation promptly and efficiently, but also effectively. So whilst an element of speed is beneficial, thoroughness is much better, but you don't need proof. That's really important. You don't need proof. That is not the threshold. Once you have determined that you are suspicious, once you've reached the state of mind of suspicion, you must submit an STR to the FIU as promptly as possible. And you would do that in the UAE through the Go AML portal. And there would then be an acknowledgement automatically generated to the DFSA. So we would be aware that a DIFC firm had submitted an STR, but we do not see the STR. We do not see the content. There is still a requirement for the firm to notify us through our e-portal that an STR has been submitted. But in due course, we expect that to fall away. There will be a rule amendment coming in due course where that requirement will be dropped because we get an automatic notification through Go AML. But I must stress that's in the future. For the moment, keep on submitting those notifications on the e-portal.
Okay, so I think this is a very good point you're mentioning, Andy. I want to come to you, Brian, on this particular point, right? So first of all, how do I know it's suspicious? Now, I'll give you an example here, which is I am selling real estate or I'm renting real estate, and I have somebody who comes in, gives me some cash. And in that case, I'm a bit suspicious that, yes, and I've been trained that cash transactions, and this is a very simple example, should be looked at more carefully. In this case, it's a single transaction. It's not a repeat customer. What am I asking the customer for? I'm asking them for an ID document. If I'm suspicious, do I ask them for source of wealth and source of funds? And if I do, and if they refuse to provide that information, what do I do? Do I sort of take a view? And again, this is not not advice, but just an opinion in terms of this situation. What would you expect me to do if you were my advisor as an MLRO?
Yeah, one, if you're talking, you are renting the apartment as a person, you know, then you probably aren't subject to rules. But you know, if you have some suspicions about a person wanting to pay you in cash for a property that you're willing to rent, do you really want that person in the property? But if you're renting or selling property, I guess dealing in real estate as a way of business,
yes.
Then you do have an obligation to have a money laundering reporting officer. The person, again, the MLRO could be inside or outside, I think, but that function exists. And that function, even if it's outside, is still the responsibility of the firm. You know, that's often an area of confusion, and it shouldn't be. That just because you outsource something doesn't mean you've outsourced your responsibility. You outsourced a duty, but not the responsibility to follow up on that. So obtaining, again, a one-off transactions, you definitely want to get the person's identification and run that through your filtering system. How much technology you use in that filtering system, you know, it's a bit of a variable. And if you are suspicious of the person, you know, you've got a business decision to make. But a one-off transaction, probably you wouldn't have a monitoring function. You would just be dealing with it up front. So different for leasing maybe versus purchasing.
Sure. So basically, you know, I'll post that question to Stuart also, right? So, you know, I'm going around and I'm being the bad guy here, and I bought 10 Rolexes, a few cars in cash, and I want to buy a couple of villas in cash, and there are different people involved. And in that situation, to Brian's point, do I, as a firm who may be selling real estate or the Rolexes or whatever have you, do I refuse the business because I do think that the person, you know, the client is suspicious? Or do I do the transaction and then report? What would be the advisable action here? Typically, you know, do you err on the side of caution and do that, or you basically file the suspicious transaction report?
Look, this is not legal advice, but I think that that is a very tough situation, I can see on me personally, I would try to refuse the business politely if it felt if it didn't feel right. I think that's an important point to this, is that there are a lot of rules and regulations around this, but there is also what feels right and what doesn't, and what seems normal and what doesn't. And we have to not forget that there's a human element of this. It's not programmatic. Humans are social beings, and we have a way to read each other. And I think that that's an important component to this. If you did do the transaction and file the suspicious transaction report, then it, I guess, would be in the hands of the government to investigate, and could be a material piece of evidence or insight that could be used to piece together a bigger story that you as a sole real estate broker wouldn't be able to see. But some examples of that are a little more clear cut than that is, if I were in real estate and someone came to me and wanted to buy 5 or 6 villas and sell them 6 months later at a loss, and move that money out, that would definitely be suspicious. If I were a law firm, and this is a case that's ongoing currently in the UK, and a Russian warlord's mother came to me and asked me to move millions of dollars on his behalf, I would think that would be suspicious, and wouldn't do that. And those are some of the more clear-cut cases that I think are facing the space. The example you gave, especially with it being the GCC, makes it more complicated. But I think there's a couple of different ways to play it. But when in doubt, I would follow the law, and certainly when I'm suspicious or have a gut feeling that something's off, you can always walk away, but you must file this STR if you didn't walk away, and make sure that it gets in the hands of someone that can see the full picture.
I think, though, it is important to note here that filing the SAR doesn't relieve you, of some responsibility here. So there's different layers. I guess you can take the money, that you think is suspicious and just be done. That's the worst layer, I guess. The second layer is, well, I'll file the transaction report or the activity report, and then my obligation is finished. It's not at that case. At least you filed, so you're going to get a point for that. But you still did the transaction with someone you thought was suspicious. So some people could still come back to you on that.
And that's exactly the point, Brian, I was trying to make there, because it's very, very important that just because certain actions required via regulation are being done does not absolve the party of the liability that they take for this purpose. So this is very, very important, I think, for everybody on the call to really understand. I think one question I want to ask all of you, and this is more around the law firm, accounting firm side of things. Typically, and I think Andy, you kind of answered this question earlier, but in the wider context, what would be the expectation for an accounting firm and a law firm where there's a more, I guess, bilateral relationship with clients, where it's not more transactional, I would say, specifically because the mandates seem to be a little bit long dated than buying a real estate and so on and so forth. So what are the KYC expectations there? And how do you go about some challenges, or if you've seen any challenges that you can talk about there?
If I could just touch on the previous topic, which
Sure.
was the conundrum of do you accept cash or do you accept a transaction about which should you be so suspicious, and what do you do with that? Do you proceed, do you report? One issue that wasn't touched on, which I think is important for the audience, if you turn the client away, or the potential client away, if you turn the business away, you should still submit an STR. That's a really, really important point. I endorse entirely all of the comments that were made about if you accept the money, you're not absolved from responsibility or potential liability if you accept the funds. However, if you do what might be deemed the right thing and reject those funds and reject that client, still submit an STR. That's really important because it's important intelligence for the financial intelligence unit, and it might well help them to build a bigger picture about that particular client. So sorry for that slight diversion, but I thought it was an important point. Turning now to your question about expectations of lawyers and accountants. Again, our level of expectation is no different to that which would apply to a traditional financial services firms, such as a bank or a securities brokerage or something of that nature. We expect them to apply the rule requirements in the same way, but on the basis of a risk-based approach. And it is important that we differentiate between the risks among different sectors and also the risks that different clients present. How do you understand the risk that a client presents? Well, that is through your customer risk assessment, which you must apply to every single customer who comes forward to you. And as long as that is well conceived and executed properly, it should give you an accurate picture of the risk that that client presents. Now, of course, risk is not static. The risk today might be X and the risk tomorrow might be Y. It might have increased, it might have decreased because circumstances change. So that's where the ongoing monitoring is really, really important. In the context of lawyers and accountants, so if I touch on lawyers, for instance, it might well be that the service requested of them is a one-off legal advice, and just for the payment of a fee. And therefore the risk, the money laundering risk, is extremely low. However, if they're involved in advising on or handling the funds in a transaction such as a real estate transaction or the acquisition or sale of a company, for instance, the risks are significantly different, and we would expect the firm to do much more due diligence in that sort of scenario. You've then got situations where, for instance, it's the service being offered is the provision of a registered office for 12 months. And again, that's ostensibly offers less risk than it might be the case if a real estate transaction was being conducted, for instance. But it doesn't mean that there's no risk, and it doesn't necessarily mean that it's low risk. So we've seen instances where a firm will say, well, the service we offered the client was an incorporation of a JAFSA company. And we did due diligence and JAFSA do due diligence. So this is a low risk scenario. Well, that's not the case necessarily. It might turn out to be the case, but it isn't necessarily automatically the case. I think the important point is no firm should be relying on the due diligence done elsewhere. They should do their own due diligence and be comfortable with a client and with a service and with a transaction within their own right. And you certainly should not be presuming that anything that JAFSA or anybody else does is a substitute for what you should do.
I think this is a fantastic point, Andy, because one thing I want to highlight as well is that typically, at least previously and to some degree even now, there is implicit reliance placed on, oh, yeah, this is coming from a bank. So from a KYC point of view, I don't have to do much. What would be your view, Brian and Stuart, on this particular point where sort of, kind of almost push all the responsibility to a regulated financial institutions? If they are doing business with you, then it's okay with us.
Well, I would I guess that's better than cash. So you've moved up a step. At least it came from a regulated financial institution in the form of a wire transfer, rather than a cash transaction. So hats off that we've lessened our risk, but we haven't eliminated our risk. And then you get into the area of how much reliance can you place on an external party for doing that transaction. So you still have an obligation to know what type of KYC, CDD that financial institution typically does. And you know, and in general, you know the reputation of most firms. So you do have an obligation to know what that firm is doing, but it does give you less of risk coming from a regulated entity.
Would it absolve the DNFBP from doing its own KYC?
It doesn't absolve the DNFBP. The DNFBP still has to do a bit of homework, but it lessens the risk definitely.
Okay.
Yeah,
Stuart?
I would agree with that.
Okay, wonderful. And I think we are pretty much coming close to the end of the webinar. There may be a couple of questions from the audience that we can take in the limited time that we have left. Jack, are there any questions that we can ask?
Hi, Jahanzeb. Yeah, a few questions in the chat. So thank you, and thanks to the panelists. So start with, where refusing the client's transaction activity could lead to risk of tipping off, do you proceed with the transaction activity and then file a SAR?
Is that for me?
I think that's for everybody, really. So I think you can go first if you
Thank
don't
you.
mind.
Yeah, the rules, and I'm sorry to keep on referring to the rules, but as a regulator, that's what I must do. The rules require that you certainly do appropriate due diligence and you identify any suspicious transactions. But by the same token, the federal law and the rules also forbid tipping off. So there is a balance to be struck there. It is vitally important that you as a firm train your staff about tipping off and what the dangers are, where tipping off might come into play, and how they avoid that scenario. In that situation, reference should also always be made to the MLRO and advice sought from the MLRO about the particular situation. Now, if it's felt that to refuse the transaction would entail tipping off, you certainly should still submit an STR. If you choose to accept the transaction, I would suggest that within the STR, you make it plain the basis on which that you decided to accept the transaction, which was to avoid tipping off, and you make that clear to the FIU. In that sort of circumstance, which is a high-risk scenario, it is really important that the firm documents everything really stringently and the thought processes that they've gone through, the discussions that they've had. It is your life belt in stormy seas. Should anybody come along consequently and say, well, what happened here? Why did you decide to do this? Who decided this? What were the factors that you took into account? And they're exactly the sort of questions that we as regulators do ask. So do be prepared to answer those questions. And the best way is to document everything down to the nth degree and make it very clear why it is you did what you did and what your justification was.
Thank you very much, Andy.
I just want to add one more point, Jack, to this. I think it's extremely important to tie in what we've discussed earlier. In the absence of proper policies and procedures and proper training, your documentation of the event and what steps you have taken would still come up a bit short of what the regulator or any regulatory authority would expect. So it's very important to look at this holistically. And these are one of those things where it's a low likely, high impact scenarios, and it can significantly distract firms from doing business and create actual criminal liability for its principals. So very important to do that. Sorry, Jack, go ahead.
If I could just add to that, from a regulatory point of view, if we inspected a firm and saw repetitive behavior of accepting funds in that sort of scenario, proceeding with a transaction because of the fear of tipping off, we would most likely take a negative view of that, because we can understand how that might occur in isolated instances. But if it's repetitive behavior, it looks like that is your policy. So it is very important that a firm does not adopt that as a sort of, for want of a better phrase, an easy way out of a situation. We would expect to see that sort of situation by exception rather than as the norm.
Wonderful. Thank you, Andy. Jack?
Thank you very much. So a question about personnel requirements for DNFBPs. Are DNFBPs required to employ an internal compliance officer? And following on from that, are they able to utilize external compliance officers and services offered by service providers?
Sorry, I'll take that as well. Certainly, under the DIFC rules, it is allowable for a firm to have either an in-house or in-house MLRO, or to outsource that function. But even where you outsource your MLRO, the firm still remains responsible and accountable for AML compliance. We fully understand that some firms are perhaps quite small, and therefore they don't necessarily have the internal resources or the internal expertise. And in that scenario, we would strongly recommend that they look for an outsourced solution. We would expect the outsourced MLRO to be appropriately qualified, experienced, and most importantly, have an understanding of that particular sector and a well-developed understanding of the business of that firm and its risks. And that is sometimes where things can go a little bit astray. We find that the MLRO doesn't necessarily have a well-developed understanding of the sector or that particular firm. So if you are going to go external, please do bear that in mind.
Thank you very much.
Stuart, Brian, do you have anything to add there?
No,
okay.
I mean, I would just add, I think also, just for the avoidance of doubt, leveraging other tools and technologies that aren't homegrown in that scenario to help you with onboarding, to help you with screening, to help you with workflows and escalation are things that would not, I don't think, be expected that a firm would develop in-house from a technical perspective, and would look for a third-party vendor to help with. And there are many out there that can help with that kind of a solution, and can help miniaturize solutions that typically would be deployed in very large financial institutions, but miniaturize them for smaller DNFBPs that want that same kind of experience and coverage.
Yeah.
Thank you very much.
I think we have time for one last question, Jack.
Okay, I think this may have come up in previous discussion. It was highlighted that AML expectations of DNFBPs are the same as that of larger institutions. Are smaller DNFBPs expected to have an equally robust framework, or is there more leniency given to them given the size, capacity, know-how, etc.?
I guess that's for me as well. It may sound harsh or unreasonable, but the answer is, if you are a registered DNFBP and you are undertaking activities which have an exposure to money laundering and other financial crimes, the answer is yes, you are expected to do a strong, thorough job. And if you're small, if you're a small firm, that's no get-out clause, that's no excuse. We still expect effective compliance. We still expect firms to deliver on their obligations under the federal law and under the DIFC rules. Now, we don't live in a perfect world. We understand that firms, both big and small, can inadvertently get things wrong and slightly go astray. And where that's the case, we work with firms to help them strengthen their compliance standards, and so that they don't fall afoul of us or the rules in the future, ideally. However, where a firm is acting in a cavalier way or in a negligent way, and I must say it's extremely rare for us to find that, I'm glad to say, but where we do find that, we do not shy away from taking robust action. And that can range from, as well, we have an escalating approach based on the seriousness of the non-compliance, which can go all the way up to enforcement action, which can include penalties, financial penalties. And the nuclear option, of course, is withdrawal of a firm's registration in the worst case scenario. And we have seen the regulators on the mainland in recent times do that on a number of occasions. So firms do need to understand that this is serious business. This is serious stuff, and we expect firms to approach it seriously.
And I would definitely highlight, I think, to your point, Andy, that I think the onshore authorities have canceled licenses for accounting firms and law firms, and they have made it public. Before, generally the view was to not name and shame. But now I think it's become very obvious that in order to ensure compliance, we have to make that public, that there is action and people cannot get away with that. So with that, I would like to thank Brian, Andy, and Stuart for your time. Really, really appreciate a really thoughtful discussion. I learned a lot, and I'm sure the audience learned as well. Again, thank you very much. I also want to thank everybody who has attended, and we look forward to taking the discussion forward. And if there are any questions, please reach out to us or to the panelists, and I'm sure everybody will be happy to support whatever we can. Thank you very much, and have a good morning in the US and good evening in the UAE. Thank you very much.
Thank you, Jahanzeb.
Thank you, Jahanzeb.
Thank you, Brian. Thank you, Andy.
Thank you, guys.
Thank you. Take care. Bye-bye.
Bye, guys.